Okay, so now, so as I was saying in the last video, after you've gotten your proxy, you have you have um you have or beta equity especially. Now, that beta equity, you want to turn it to beta asset. Why? Because you are already assuming that number one, your company and the proxy company, you don't have the same debt structure. All right. Maybe in their capital, debt forms 40%. Your debt forms 30% of your capital. So you don't have the same debt structure. So that is why you don't want to bring in their own fund. You can't just use their beta equity like that. So because you'll be using their own financial risk. So you need to estimate your own. So what you need from them is something that is universal to all companies inside the industry, which is the business risk, which is estimated using beta asset. So that's why in step two, you are going to be on gearing, you'll be using the beta asset. Now, all these things we are seeing is called beta analysis, risk analysis. All right. So when you calculate the beta asset, okay, now you are not going to have now you are going to have you are going to have a you are going to have a beta asset business risk. Then in step three, you are going to be calculating beta equity again. That's why they say regear. So why are you doing that? The reason is because the project you want to do is going to be financed by debt. It's going to be financed by debt. So it's going to be a geared company that you want to start again. So that is why you are going to recalculate beta equity. But this time around, you are using the beta equity you got, the beta asset you got in step two, and the information of your own proxy company anymore, and using the formula of beta asset in this case. Then after you get that in step three, you get beta, sorry, using the formula of beta equity in this case. Then after you get the beta equity in step three, you come to step four, cap. The beta equity you got in step three, you put it in capping formula, you calculate cost of equity, it becomes down. So the cost of equity, you use the WACC formula, you calculate WACC. So starting from the you see how it flows into the WACC, the business risk flow into the calculation of WACC. Now, this is why I said the understanding of this thing matters. Examiner, it is possible that examiner just give you proxy information, and it happens that proxy only does the thing you want to do. Food, drink, happy. That's the new business you are moving into, and that is the only thing proxy is doing. So examiner will now be okay. They now give you the beta assets of the food, drink. What do you need again? You don't need to do step two anymore. You already have the beta asset. Just jump to step three and regear it to become a beta equity because your own project is going to be financed by debt. And if your debt is not going to be financed by debt, you will jump three. The beta asset you have, you just put it in capping formula. It becomes calculation cost of equity of an peer company. All right. So it is possible from this examiner may make you jump step two and do step three, or do step two and jump step three. All right. How do you jump step two and do step three? All right. I mentioned it. They give you a beta asset. You need to calculate it, but you have to be careful. The beta asset examiner is going to give you from proxy. It has to be the beta asset of what you want to do. It is possible proxy is doing fruit drink and cement, and examiner now going to give you the beta asset of cement. What do you need? You need a beta asset of fruit drink. So that's not what I'm saying. So what I'm saying is you need a beta asset of fruit drink, and examiner gave a beta asset of fruit drink about proxy. That's why I'm saying you are going to jump step two. All right. So let us then you just move to step three. Then from step three to step four. Sometimes it would be that we are stopping our calculation at step four. That is, examiner is not asking us to calculate what. Just want us to calculate cost of equity. So understanding of the principle is really, really important. Now, let us look at the question. ICAN question, May 2017, question 1. Okay, let me share the question. Let me share my screen quickly. May 2017, May 2017, question 1. Okay. Now, okay. Question one. Okay, this is a question. Saying that, saying that, um, we have, we have, okay, I think I've passed. Okay, good. Now, this question one, May 2017, question one. Please, I advise you open this question or observe when you are watching this video. Okay, I'll open it on the side. It's a long question. So let's go to the requirement. We are looking at question number 1A, requirement. Given, we are looking at 1A, okay? We're looking at question 1A here. So given the information of me, MPLC, and the project financing mix, including any other relevant information, calculate the project specific cost of capital. You hear what they say there? Project specific cost of capital. Project specific cost of capital. Okay, let us go through the story. Let's go to the story. Okay. Now, so let's go to the story. Okay. I'm not going to read everything. Okay. Just because it's a long question, there are so many, there are like 2 or 3 topics inside this question. So I'm just going to read the first paragraph now. KPLC, a listed company based in Warri, Delta State, has been involved in production of boats, but excluding engine. The company is now considering diversifying into the, the production of a major component of outboard engine. For this purpose, the company has recently purchased the patent right for 15 million naira. Now, I stop here. You can hear that they said the company wants to diversify. They want to diversify now means that they are going to be doing what they have not been doing before. They produce boats, but they now want to start producing the engine. That's another industry. So when you notice that in the question that is a project and they want to diversify, you need proxy. So try to scroll down. They normally put proxies information towards the end of the message in the last paragraph, second to last paragraph. Now, they have already mentioned inside the requirements about MEPLC. Look at it. Marine Engineers PLC, ME. Okay? It is a listed company involved in the manufacture of outboard engine components for many years. Additional data, extract from extract from statement of financial position. Okay, extract from statement of financial position. Okay, we have look at the statement of financial position, KPLC and NEPLC. Okay, non-current assets, we have working capital, we have 6% loan. 6% bank loan belongs to KPLC, 624. 5% loan notes belongs to me PLC, which is 2020 to 2022, which is 368 million. Share capital of 50 kobo per share belongs to KPLC. Share capital of 1 naira per share, that's 500, belongs to me PLC. Reserves, then current market value per share. KPLC is 3 naira 50 kobo, me PLC is 3 naira. Quoted beta, that is 1.3 for K and 1.8 for me PLC. Now, the beta that you are seeing, we are going to name it beta equity. The reason the examiner just said beta, they didn't say whether beta asset or beta equity. So, or we are going to say beta equity. The reason we are going to assume it is beta equity, when we are stating assumption, we can state it there. That is how you state assumption. You are not saying that, oh, it is assumed that that quoted beta is beta equity. Since KPLC and Me PLC both have debts in their capital structure. At least KPLC has bank loan, Me PLC has loan notes. The loan notes of Me PLC are quoted at 102 per 100. So loan notes is a traded debt. You can see the nominal value in this question for that debt is 100. That is why they are saying 102. Okay, other information, other data. Tax rates applicable to KPLC and Me PLC 15%, 20%, 20%. It can be assumed that tax is payable in the same year as the profit on which it is charged. Estimated risk-free rates of return 3%. Historical equity market risk premium is 6%. That is market premium. So R, that is R minus M. They have given it to us. Okay, they now say we should calculate project specific cost of capital. What is step one? Step one is to identify proxy. We have identified proxy, and proxy is MEPLC. Okay, so we are going to let us go back to the board. Now, going where here we have Me PLC. Okay, Me PLC. What are step one? Step one says proxy. Okay, so what we are trying to calculate, we are trying to say, for KPLC, okay, for KPLC, we are trying to do calculation of risk adjusted costs of capital. Project specific. That's what it said in the question. Project specific cost of capital. Calculation of project specific. Project specific cost of capital. WACC. That is what we are calculating. Step one, which says proxy. So what are we doing? What are we doing with proxy? What are we doing with proxy? Let's bring proxy's information out. MEPLC, go back to the question. Go to the statement of financial position, extract of statement of financial position. What is MEPLC's quoted beta? That is their beta equity. The quoted beta is 1.8. What is their market value of equity? The value of equity, we need that as well. Those are the three basic things that are needed here. Minimum things that are needed. Value of equity is needed. What is the market value of equity? If you look at it, they say current market value per share. KPLC is 3 naira 50 kobo. Me PLC is 3 naira. So we are going for 3 naira, which is for Me PLC. 3 naira per share. Make it in total. I want us to do it in total. Times 500 million shares. How did I get 500 million shares? Look at Me share capital. The share capital of Me per share is 1 naira. The total capital is 500. What is the number of shares? Do you understand? One share is 1 naira. Total shares, everything, 500 million naira. What is the number of shares? Just say 500 million naira divided by, that's 500 million shares. So that is what I am doing here. Okay. 500 million naira divided by 1 naira. That's 500 million shares. So 500 million shares times 3 naira. That is 1,500,000,000 naira. So that is the market value of equity of the proxy. Then the market value of debt. The market value of debt of NEPLC. What do we have? They said NEPLC has loan note, and the loan note is quoted at 102 per 100. They've given us the unit price. 102 is the unit price divided by units, 100, times the book value. What is the book value of the loan note in the balance sheet? The loan note is 368. 368. It is equal to, please, again, I want to say this. If there is any question, just please chat me up on WhatsApp. Thank you. 102, 102 divided by 100 times 368. All right, times 368. I got 375.36. 375.36 million naira. Okay, that is the market value of debt of the proxy. Okay, so we've gotten beta equity, we've gotten market value of, we've gotten market value of equity, and we've got market value of debt. Okay, we need tax rate, Sha. Tax rate is how many percent? 20. 20%. Okay, after we've gotten all this information, we don't have to really state tax rate is universal for everybody, unless it is peculiar to, but tax is needed. That's why I'm also stating it. Now, in step two says ungear. What do we want to ungear? We want to ungear this beta equity. We want to turn it to beta asset. So we need the formula for beta asset, which is beta asset is equal to beta equity times value of equity divided by value of equity plus value of debt, 1 minus T, that's tax rate. So we don't have beta debt. So the other side of the formula becomes 0. So what do we have? What is our beta equity? 1.8 times what's our value of equity? 1,500 divided by 1,500 plus 375. That is the value of debt, 0.36. Then 1 minus 0.2. That is net of tax. Okay. So what is the answer? What is our beta asset? So the beta asset here will be 1.8 times 1,005. Okay. Okay, let me do this way. So follow the rule of Bodmer. So let me deal with the denominator inside my calculator first. 1 minus 0.2 is 0.8. 0.8 times 375. 375.36. Okay, equals to this, plus 1,500 equals to this. All right, then we'll now say, we say 1.8. I got the denominator that I got 1,800.288. So I want to say the denominator, I want to do the numerator now. 1.8, whatever that is, 1.8 times 1.5, close the bracket, divided by the denominator, which is the answer. I got 1.49 or 1.499, 1.5 approximately. So our beta asset is 1. Our beta asset is 1.5. 1.5. So we've been able to ungear the beta. So you can see the beta asset is 1.5, beta equity 1.8. It is lower. Okay. By default, beta assets will always be lower than beta equity because beta equity contains two things: beta asset and business risk and financial risk. Okay, so that means beta asset is already inside the beta equity. Okay, let us move to step 3. Now, the project we are going to do is going to be financed by debt. How did I know? If you go back to the question, to the story, there is a paragraph that starts with, though the paragraph before Marine Engineer PLC. Although I want to read, although this would be a major undertaking for the company, it is confident that it can raise the finance required for the machinery and the first year's working capital. And the financing will be through a mixture of a rights issue and a bank loan. So bank loan is there in the same proportion as the market value of current equity and debt capital. So they have already told us here now that the project is also going to be financed by debt in the same proportion. This is what it means. Although we are not supposed to use I'm coming back to this explanation later. Because we are going to use market value of debt and market value of equity in step 3. We are not supposed to use the market value of debt or market value of equity that KPLC has already. We are supposed to use the market value of debt, market value of equity of the projects, the debt and equity of the project. That's what we are supposed to use. But since we are actually looking for gearing, since examiner said is going to be in the same proportion, that is, if currently debt forms 20% of their capital, by the time they are going to raise money for this project, they will raise money, debt will be 20%, equity will be 80%. That's what they are trying to say. So in this case, examiner allows us, with this they have done, they allow us to use the current market value of debt and equity of KPLC to carry on with our cost of capital calculation. So let's move to step 3, which is regear. Regear. Now, before I mention regear, we need market value of debt of KPLC. Okay, let me say KPLC market value of debt is, the debt is bank loan. I have told you when we're doing debt, the market value of bank loan of debt of non-traded debt is the book value, which is 624 million naira. Then their market value of equity, the market value of equity is going to be, the market value of equity of KPLC is 3 naira 50 kobo. That is 3 naira 50 kobo times, what do they have? They have number of shares will now be 208 divided by 0.5. One share is 50 kobo. The share capital now, one share is 50 kobo. Look at the balance sheet. One share is 50 kobo, and total value capital for those shares is 208 million. So if you say 208 million divided by 50 kobo, okay, we are going to have numbers of 208 divided by 50 kobo. Number of shares, that's 416 times 3 naira 50 kobo. We have 1456. 1456 in million. So that is the market value of equity of KPLC. We can say, because we are going to need it, total market value of the company, which is VE plus VD. That is 1456 plus 624. What do we have? We are going to need this when we are calculating the WACC. Okay, 1456 plus 624. We have 2080, 2,080,000,000. So that is the total of the company. So let us leave this place and let us go back to our Let us go back to regear. So regear, when you are regearing, okay, okay, you need what? You need equity, okay, beta equity. When you want to um, when you want to when you want to regear, you need beta equity regear. So we need beta equity. So beta equity formula, it is equal to beta asset plus, open a bracket, beta asset plus beta debt. Don't worry, this formula, even you just need to know how and when to use it. Value of debt, 1 minus tax rate divided by value of equity. Now, value of debt and value of equity we are going to use here. It's not for proxy. We are not using that. We are using that of the main company, which is KPLC, the main company we are working for. So beta equity equals to, what did we get for beta when we're calculating beta asset? We got beta asset of 1.5, just 1.5, not 1.5%, not 1 times, just 5. So we got 1.5. So we say beta equity is equal to 1.5 plus, open a bracket, 1.5 minus 0. Beta debt is 0. Value of debt is, for the main company, is 624. 1 minus tax rate, that's 1 minus 0.2 divided by 1,456. So our answer, our beta equity will be equal to, if I say 624 times 0.8. How did I get 0.8? 1 minus 0.2 is equal to 0.8. So times 0.8, I got this, divided by 1,456. I got another figure. Whatever I get, I multiply. You see in the bracket, I'm expanding the bracket. That is 1.5 minus 0. So that is, in the bracket is 1.5. So I multiply it with 1.5. Whatever I get, I add it with 1.5 and I get 2. So the beta equity is 2. Move to step 4, which is capping. Capping, capital asset pricing model. We are using the capping formula, which says KEG, because the project we want to do is a geared project. The KEG plus risk-free equals to risk-free, plus beta equity market return minus risk-free. Okay, so KEG equals to, what's risk-free inside the question? Go back to the question. Yeah, I think the risk-free, find it inside other data. Risk-free rate, 3%. 3% plus beta that we just calculated, 2. Beta equity is 2. They gave us market risk premium, which is 6. Market risk premium, which is 6. We don't need to say 6 minus 2. If they had said market return, that's why we will say 6 minus 2. Okay, so market risk premium. So we say what's going to be our cost of equity, the cost of equity of a geared company. We have 2 times 6, that's 12, plus 3, that's 15%. 15%. That is our KE. Okay. Then we'll now move to the last steps, which is WACC. So what's WACC formula? KE times VE divided by VO, close the bracket, plus KD VD divided by VO. Okay, so our KE 15, our VE 1 think 1456. VD is 624. So 1456 divided by 2080, right? 2080. Yes, that is VO. Then 624 is the VD. And that is, what is KD? 624. 1 minus 0.2. 1 minus T divided by 2080. So what is KD? Go back to the question. What's the bank loan? It says 6% bank loan. So the cost of debt is 6% net of tax. Okay, so 6%, 6%. Okay, now, so we got to let us calculate our WACC. Okay, I will say 1456 divided by 2080 multiplied by 15. I get 10.5 plus, I'll say 1 minus 0.2 is 0.8. 0.8 times 624 equals to this, divided by 2080 equals to this, times 6. I get 1.44. So the total answer, our WACC, which is our project-specific cost of capital, equals to 1.44 plus 10.5. I have 11.94%, approximately 12%. So that is the cost of capital, project-specific cost of capital. That's what they're asking us to calculate in requirement A1, project-specific cost of capital. Now, if you look at the same question 1B, that's the one we did was 1B. If you look at question 1B, they said, assess whether KPLC should be undertaking the project, whether KPLC should undertake the project developing and commercializing the major component of outboard engine, assuming a discount rate of 12%. Can you say that 12% we got has been applicable for assessment, irrespective of your answer in A above. Okay, so, well, we've been able to get the 12%. Okay, very well. So, for now, we're going to stop here. So, look at this question, practice this video. This is one of the simplest questions. These are start and practice it. Then in the next video, we're still going to solve another question. We're going to learn another thing, but another which is capping as well. But it's going to be more comprehensive than this. All right, please practice very well and practice very well. All the best. Thank you, guys. Bye.